Insurance contracts. By the end of this lesson, you should be able to describe the parts of an insurance contract. Some common elements of insurance contracts: the declarations, the insuring agreement, conditions, exclusions, definitions, loss sharing provisions, and last, endorsements, riders, and policy continuation rights. Starting with the declarations. These are usually the first page of an insurance contract. It personalizes the insurance contract to the insured. It will contain such things as the name of the insurance company, the name of the client, the policy period, policy limits, applicable deductibles, the premium, and also the forms and endorsements that are included on the contract. In the definitions section, this helps to clarify the meaning of words and terms in the contract. It's found in the definitions page, glossary, or throughout the contract, and it helps to reduce the word count in the policies. The insuring agreement broadly describes the insurer's rights, duties, and obligations. The exclusions identify the losses that are not covered. It's designed to eliminate catastrophic events such as flood, war, or earthquake, eliminate moral or morale hazards, intentional loss and failure to protect property, can define extra charges. For example, a gun collection, a client who has $100,000 of guns, there's a sublimit on the standard homeowner's insurance policy that may limit that to $5,000 or $10,000. And also to eliminate coverage when another policy is specifically designed for that coverage. For example, cars are not covered under the homeowner's policy because they have a policy unique to automobiles. The conditions are what's required of the client for the claim to be paid. If you want to have the claim paid, you must meet the conditions stated in the contract, such as concealment and fraud, suspension of coverage, cancellation, other insurance, duties after a loss, the appraisal procedure, salvage, and claims payment time limits. The concept of loss sharing is brought about via deductibles. Deductibles can either be a flat dollar amount, such as a $250 comprehensive deductible on a car if it's stolen, or it can be a percentage. For example, in a homeowner's policy, a 1% of the coverage A dwelling amount could be the deductible for any losses, physical losses to the house. Some reasons for having a deductible are that they reduce moral and morale hazards, they eliminate small claims, and they lower the premium. The endorsement section deals with endorsements and riders that modify standard insurance contracts in predetermined ways. They can expand coverage, they can delete some exclusions in the contract, they can change definitions, and they can add additional locations and insureds. Policy continuation rights. Some examples: non-cancelable policies. A provision that gives the policy owner the right to renew the coverage at each policy anniversary date, sometimes at some stated age. For example, term life to age 70. It can be renewed every single year until you hit age 70. In a truly non-cancelable policy, the rates for coverage are guaranteed in the contract. Another concept in policy continuation is guaranteed renewable. The policy is similar to non-cancelable, except that the rates for coverage are not guaranteed in the contract. An example of this would be a guaranteed renewable clause in an auto policy, and the client has 2 or 3 accidents in 1 year. They will not be canceled. The policy will be renewed, but their rate will go up substantially. To summarize, we have just reviewed common elements of an insurance contract. Thank you.